Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw, the senior market specialist at FXCM. My email address rshaw@fxcm.com, and today is it's Monday, the 7th of March, 2022. Just going to keep the high risk investment warning up. I'll keep this on screen for a few moments. Here's our market commentaries disclaimer. And here is references. FXCM Market Scope 2.0. I'm going to read from the CNBC.com morning note, and we'll take a look at tradingview.com. Let's go with CNBC first. Hey Howard, good morning to you. Yes, it was a good weekend. I hope you had a good weekend as well. All right, let's just go through the headlines. We've actually got, I think, a fair amount to do this morning. European market set to fall as US, Europe consider Russian oil ban, oil prices surge. Okay, that's very important. European stocks are set to tumble on Monday after news that the US and European allies are considering a ban on Russian oil imports, posing a risk of, what have we been talking about? Stagflation. Okay, we're going to talk about that in more detail. Last week, the pan-European stocks 600 benchmark lost 7% and suffered its worst week since March 2020, the onset of the coronavirus pandemic. US Secretary of State Antony Blinken told NBC on Sunday that Washington is in very active discussions with European governments about banning imports of Russian crude and natural gas. Such a move could pose a risk of stagflation, a period of slow economic growth and high unemployment. Okay, high unemployment coupled with high inflation for the global economy. Oil prices surged to their highest since 2008 in response to the news, with international benchmark crude last seen up 10% to around $130 per barrel, and US crude up 8.8% to around 125.80 per barrel. Russia has continued to ramp up its assault on Ukraine in recent days, with forces attempting to advance and isolate the capital city of Kiev and other major cities, while being met with fierce Ukrainian resistance. Western powers have already imposed a suite of punitive economic sanctions in a bid to isolate Russia from the global economy, but the Kremlin has continued its invasion, and Ukrainian President Zelensky has urged NATO to implement a no-fly zone in Ukraine, as yet to no avail. Shares in Asia Pacific were sharply lower on Monday, with Hong Kong's Hang Seng Index dropping more than 3% to lead regional losses. US stock futures pointed to a negative open on Wall Street later in the day. Yeah, all right, let's see if we can come up with something usable. I mean, the news here is unbelievable. Every day it's getting more and more intense. Imposing a no-fly zone is a huge step up in a global escalation. So we're just going to have to see where that goes. I would be surprised if that's implemented, but I've been surprised to no end over the last week. So we'll see what happens there. I do know that there is a whole lot of Stinger missiles that are getting sent into Ukraine. I'm not a military expert, but as far as I understand, those Stingers are kind of like bazookas. They're not fixed anti-aircraft. Usually what happens is the Air Force goes in, takes out anti-aircraft, and then carries on bombing. With the Stingers, it's much more difficult because it's effectively very mobile. But I think to get a no-fly zone in that's a huge escalation upwards. So we'll just have to see how that pans out. As I say, I'd be very surprised if we move in that direction, but I have been constantly surprised throughout the last week and a half. All right, I want to bring up a couple of charts. This is the US yield curve. Here's zero. Okay, it's quite difficult to kind of get your head around what's going on here because it looks like it's negative. It's not negative, it's flattening. So what we when it hits zero, we had a perfect horizontal. Once we dip below zero, the yield curve inverts. So let's just explain that because I think this is a meaningful chart which we're going to have to keep our eyes on. Yeah, so Anna said NATO stated categorically that they won't do that because it would mean sending NATO aircraft in. Okay, yeah. So I also don't see it happening. Let's just talk about this yield curve. Just bringing up Microsoft Paint. All right, so we've got this curve that's usually the curves look like this. They're not linear. You probably have a curve that looks something like this. Generally, this would kind of be a normal yield curve. But for the sake of it, let's just keep these linear. And what you have here is the short-term bulls, and what you have here are the long-term bonds. When we're looking at the 2s, 10s, we'll refer to them as notes. That's the sort of the parlance. So what happens is generally in a normal yield environment, the 10-year, so this would be 10-year, would give us a higher yield than the 2-year. And I think we would all agree that makes a certain amount of sense because you would be rewarded for the maturity, right? You'd have a maturity premium built in here, maturity premium. Okay. You would also have a inflation expectation built in. In other words, you'll think, well, in 10 years, we probably have more inflation. It just makes sense that we should be kind of rewarded for that over. So what's happening? Let's go back here. Is we actually getting to zero? We're getting to flat. In other words, the way that we work this out is we take the longer, the 10-year, and just subtract the 2-year yield. So let's just say the 10-year over here was at 8%. Let's say the 2-year here was at 2%. Well, then the spread is 6%, reflected in the positive slope. But as we see here, we're getting to a point where the 10-year minus the 2-year is getting pretty close to zero. In fact, we're only 25 basis points away from being completely flat. So the question is, what's going on here? Let's just talk about this for a moment. We're getting a yield curve that's effectively looking like this. Your yield for the 2-year is as much as your yield for the 10-year. That's why when you go 10 minus 2, you're going to get 0. At the moment, we kind of very flat, kind of like this, very flat. And there is a number of reasons for that. First of all, the 2-year is increasing at a rate of change much faster than the 2-year. So let's just go back to this over here. So what I'm going to do is I'm going to just take out the 10-year, and we're just going to take a look at the 2-year. Okay. So look at this. This is just the 2-year. Look how steep the 2-year is, right? So you can see the rate of change here is the momentum here is very strong, albeit it looks over the last 4 weeks we've started to slow. We're going to talk about that in a moment. Okay. And if we go through to the US 10-year, it's moving up, but it's moving up at a much slower pace. It's moving up at a much slower pace. And that's why when you put in fact, you can see over the last few weeks it's come down, right? That's why when you subtract the 2s from the 10s, you get a exceptionally flat yield curve to the point that it is borderline inverted. Now, an inversion does not mean that we're going into a recession. However, all recessions have been preceded by inversions. Okay, so whilst there is not necessarily a causal relationship from inversion to recession, it does seem to be an effect relationship that so there is a danger here. Now, what's happening is that the Fed is very aggressive in terms of rate hikes. That's why we're getting the 2-year so steep. It's the Fed and central banks in general operate on the short end. Now, we know that they're being exceptionally aggressive because of high inflation. They've slowed down the asset purchases to the point that it's due to end this month, right? And they are going to look to shrink their balance sheet, and they are looking to hike rates. 25 basis points is the expectation on the 16th. And, you know, the market was talking about 7, 8 hikes. So we've got this big, huge kind of steep curve that's moved right in. And then the 2-year is not driven so much by the Fed, it's driven by investor expectations. So the investor expectations seem to be suggesting, well, you see, what's happening here is as yields go up, money must be coming out of bonds. That's the relationship there. We're not going to get into that, but I think we would all understand. We would all know that the bond market is inversely related to its yield. We have discussed it before. We'll discuss it again in the future, but not now. But essentially, it means that there is much more money going out of short-term bonds because the interest rates are going high than out of the longer-term bonds. Much more caution in the longer-term expectations. So we're getting to a point, does everyone understand? So the expectations for the long term are much more cautious than the expectations for the short term. And this is a problem for the Fed. Okay, the Fed doesn't want this inversion to happen, but we're heading towards it. So that's the first point. The second point is there anything the Fed can do about it? So I think there's two aspects to this, and we're in a very complex economic environment, and this is what we've got to try and deal with as traders. So the first thing is, well, the jobs number on Friday, okay, specifically the wage inflation number came in at 0%. Wage inflation came in at 0%. And that was off of an expectation of 0.5% month on month. Year on year, there was a big miss there. The Dow Jones had the number at 5.8%. It came in at 5.18%, I think. So there was a big miss there in terms of wage inflation. So inflation in the wage numbers missed. Plus, the wage number for the previous month was revised downwards. It was not by much, but it was revised downwards from 0.7% month on month to 0.6% month on month. Okay, so then the question now is perhaps inflation is starting to moderate. Perhaps. Now, if inflation is starting to moderate, there's a CPI number this week. We want to watch that. We want to just see if the Fed is what Pete called, I think Pete said it last week, boxed in a corner. And I think that the only way that the Fed is going to be saved here is if inflation moderates. Okay, so in other words, the 2-year yield here may be overpriced. Okay, remember, markets are efficient, information is inefficient. Okay, so this was discounting a very aggressive Fed. Well, maybe the Fed is not going to be that aggressive. Maybe this is going to moderate. Maybe this is going to moderate. If it does moderate, then hopefully the 10s, 2s start to steepen. Okay, start to steepen, start to move away from that zero. Also, if the twos, if the rate hikes start moderating, then perhaps if we go back to the 10-year, then of course perhaps we start moving towards this head and shoulders target, which would steepen the yield curve further. Something for us to watch. Remember, if we hit that zero and go under, it doesn't mean there's no causal relationship that there's going to be a recession. However, there's an effect relationship. Every recession has been preceded by an inversion. I hope you guys get that. So it doesn't mean we'll have a recession, but certainly gives us a higher probability of recession. Now, that's the first point that we have to talk about at the beginning of this week. Okay. The second point that we have to talk about is, of course, the oil price. Okay, so here's the oil price. Here's where it closed on Friday. Okay, here's where it opens. We're looking at Brent, by the way. This is UK oil. This is where it opens this week. So there's this huge gap. This now becomes a huge focus for us. Because gap analysis is exactly what we started last week talking about. And if you remember what we spoke about, there was a question here. Are we looking at a breakaway gap? Okay. Are we looking at a breakaway? This wouldn't be a breakaway. Let's call this a runaway. A breakaway is typically at the end of a breakaway is typically at the end of a consolidation. Runaway is a gap during a trend. So this might be a runaway, or is it an exhaustion gap? Okay. So in other words, is this an overreaction? Now, of course, we're talking about banning imports from Russia. So there is a very strong possibility it's a runaway gap. What's going to be interesting is how this price action develops from here. I can only, the politics has made analysis almost impossible. It changes from day to day, Pete. It's making the analysis extremely difficult. So as a technical analyst, there is something here called island reversals. Let me just explain to you what an island reversal is. An island reversal is typically something like this. It kind of there's an exhaustion gap, and then there's a breakaway gap to the downside, and then we kind of, so in other words, that the island reversals because of extreme speculation. I don't know if that's what's happening here. I'm just telling you a possibility. It doesn't have to be that. This could be a runaway gap, and of course, it's all about now whether the Saudis are able to ramp up production. I read somewhere that Iran has allowed a nuclear inspection come in, which was one of the prerequisites for them to bring oil back into the market. But you know, however it plays out, the question here is runaway versus exhaustion. Runaway versus exhaustion. I don't have an answer for that, by the way, but that's what we're looking at. Another way that this could pan out is something like this. Yeah, exactly. Island reversal. Exactly. Yeah. We could have some sort of price action over here, kind of not doing much, just sort of hanging around the 130 area. Then hopefully there's some sort of de-escalation. Hopefully there's some sort of de-escalation, and then we could have a sort of an island reversal like this. An island reversal like this. Okay, so we might have some sort of congestion and then some sort of breakdown. But I think you guys get the idea. It may, of course, move up like that. We are in a very, very uncertain environment. Howard's just written here that the sound disappears every now and then. Can you guys just confirm that there is a sound issue here? Just let me know, please. Are you guys, is the sound breaking up? So Lisa, Anna, Francis, Joachim are saying it's okay, Howard. So I think it may be on your side. Just let me know. Okay, cool. I'm going to continue. So I want to take a look now at wheat. Let's just bring up wheat. I think I took wheat out of this last time. Let's just bring up. Sorry, last time I made an adjustment here. I think I took wheat out. I want to bring that back in. I'm not going to take a look at cable. Well, I might. Let's take a Kiwi. We won't look at Kiwi. And we'll take a look at Loonie because it's tied in with oil. Let's take out this. All right, so let's just put in wheat. And let's put in corn as well. Okay. So we'll just take a look at that. So, what I want to emphasize here is there's this big gap up. That's a bad. This is bad news for economics. Okay. The only thing that's going to save economics here is if it's an exhaustion gap, and that's. I mean, I don't know if that's likely or not. At the moment, perhaps the runaway gap seems to be the more likely, but we'll just keep this here and keep an eye on it. Let's just take a look at the Loonie because it's tied in with oil. Just wanted to see. Interestingly, it's drifting. Okay. I'm not going to spend too much time on this. I want to just go through to wheat. All right. This is wheat. And both Russia and Ukraine are huge players in the global wheat market, especially in export. As Anna said last week as well, also fertilizer. So it's not easy to replace the wheat. Okay, you can just see this has moved up. This has now gone limit up again today. So there's no trade. There's no trade in wheat. Let me show. It's hit its upper boundary, but you can see the prices in wheat. So that's going to affect all of us going in to buy we're going to buy our sort of loaves of bread, right? Let's just take a look at corn. Okay, so here's corn, also a gap up. All right, so these are like our soft commodities. You can see that there's having huge. My point is that there's huge cost pressures here. Let's just understand. We've looked at oil, it's gapped up. We've looked at wheat, it's limit up. We've looked at corn, it's gapped up. Okay, let's start doing a bit of economics. And after that, we're going to take a look at the DAX. So just bear with me, but I think all of this is important for us beyond trading, but certainly we're going to tie it back to trading in a moment. All right, before the outbreak of the geopolitics, okay. Pete's just writing here, Russia getting out of the West internet using its own system. Yeah, and by the way, on a similar vein, MasterCard and Visa have cut off Russian banks. So they're looking at Chinese sort of payment systems. Russian banks are starting to look at Chinese payment systems. That's just going to be interesting as well. Let's just take a look at this. So we'll call this inflation. All right, here's GDP. All right, let's put in our full employment level, okay, which we call potential, but let's, for the sake of this webinar, we're just going to call this full employment. So this is where you want to be with as little sort of external damage as possible. You want everybody that is of working age to be employed. So there should be an O here, employment. All right. Built into full employment, there is something called the natural rate of unemployment. Every country has got a natural rate of unemployment. So it's when we talk about full employment, we're not talking about every single citizen of working age being employed. We're talking about every citizen being employed, factoring in a natural rate of unemployment. Okay. Now, what happened is the COVID crisis hit. Our economy moved this way because there was just a ton of jobs that were lost. And what we're going to do is we're going to start off our analysis over here, like this. And we're going to call this aggregate demand. And we're going to call this aggregate supply. And we kind of we're at a very low level of inflation. So this is a theoretical model, but what we'll call this is inflation low. Okay, so that's where we're starting. All right, and then what happens is there is a whole lot of fiscal policy. So what's fiscal policy? That's government infrastructure spending. And there was a huge response by central banks. They pumped liquidity in, and we actually, let's say we've moved to this part. Let's say we're around about here. Okay, this is theoretical, but let's just say we're over here. Okay, and we say we've jumped from 80 to 81. Just to give you an idea how that works, part of aggregate demand will be consumption, government spending, business investment, net exports. As soon as you get that liquidity pumped in, as soon as you get the government spending on infrastructure, that causes a jump in consumption, causes a jump in business investment. That government expenditure causes a jump. Exports potentially jump as well. When net exports, let's say, and all of a sudden, boom, you've got this 80 that's shifted up to 81. Now we let's call this inflation high. So this is where let's in this example, we all kind of worried about this inflation high, and we're talking about a situation prior to the geopolitical escalation. Okay, so that's where. So now, if you're the central bank, you go, look, we're running an inflationary gap. Okay, in other words, we passed this full employment level. We're actually running an inflationary gap. To the left, we call it a recessionary gap. To the right of full employment, it's an inflationary gap. We need to just calm the market down. We're at high inflation. Let's try and get us to here. Let's try and get us to here. We can live with this. This would be, let's change this to red. This would be pretty close to full employment. It would also moderate the high inflation. This is kind of 80 target, let's just say, right? So we kind of want to get here. So at this point, say the Fed would be happy. Okay, policymakers happy. We'll just say policymakers happy. Okay. Now, prior to escalations, this is what we were examining day in and day out. Are we getting past this? Are we managing to reduce this inflationary gap? That was kind of the big question. Now, what we've looked at a gap up in oil. We've looked at a limit up in wheat. Three days in a row, 4 times since escalation started. We've looked at corn jumping in price. In other words, we're starting to see a whole lot of supply side pressure here. We're starting to see. Now, let's just say that you are a manufacturer and you are manufacturing, your manufacturing process depends on energy, on fuel to run your processes. Let's say another person is a mill, and they use the wheat and they turn that wheat into flour, and then they pass that flour on to to the bakers, and the bakers bake bread. But the wheat that the mill's getting is now hugely expensive. The oil that the manufacturers are getting are hugely expensive. That's going to eat into what we call gross margin. Okay, businesses are heavily focused on their margins, so they want to control their margins. Okay, so what happens is the supply side prices. Well, we've been looking at AD jump to AD1. We've been considering a shift from AD1 to AD target. Okay, that's all within the realm of policymakers' power. Now, let's change this to a purple. We're getting a shift in aggregate supply. So now we've got AS going through to AS1, and that's not because of anybody sort of consciously making any monetary or fiscal decision. This is because of what we call a supply shock. Why is there a supply shock? Because there's a huge geopolitical escalation that's really a complicated economics, let alone just the humanitarian crisis behind that. The economics has jumped. Now look what happens so let's just say we get to AD. Let's just say the Fed managed to get from AD1 to AD target. Okay, so the red line is the current. Look what happens with the supply shock. We move further away from full employment, so it exacerbates, okay, a recessionary shock because it's moved away from this level. See, we've moved from this level that way, okay? And look what happens to inflation, okay? It's taken us past inflation high. So it's taken us from policymakers happy, past the inflation high, through to, now this is the stagflation we read about. This is what stagflation is: low GDP, lower growth, moving away from full employment. Remember, it said higher unemployment, stagflation, at a higher price. We haven't seen this since the 70s. Okay, now the question is, how do you deal with stagflation? Let's just say you're the central bank. You go, okay, well, look, we've got a situation now where we want to move from there back to there. We want to move from there back to there. Can the central bank do that? Let's go back to red. Okay, they're going to shift. Yeah, sorry, got that wrong. They're going to shift. They're going to use monetary policy to shift here. So they expand, they get back to full employment, but there's a price. We're at unacceptable inflation levels. So the central bank cannot pursue an expansionary monetary policy because they're going to make inflation worse, okay? And there's going to be a huge social outcry. Okay, so if that's the case, can they lower the inflation? Well, what they're going to have to do then is go into a contractionary monetary policy. They're going to have to go here. Okay, so now we're back to policy makers happy, but we've just exacerbated the unemployment problem because we've been, contractionary means we've raised interest rates. So what do? You can't lower interest rates. You can't heighten interest rates. It's a terrible situation to be in. Stagflation is a policymaker's nightmare. Governments, by the way, won't be able to do anything either. Can they pull back on structural spending? Can they push up structural spending? They're going to do the same. The aggregate demand curves are going to act exactly the same way. They're in a trap. So how does an economy move out of stagflation? Well, it's very difficult. There is a slow process of normalization that takes place in the labor market. and that is through forced wage reduction. It's the only way that, okay, that's where the this is what, so as wages come down, the supply side are managing to control their margins because they're paying less wages, and eventually the supply curve makes its way back here. Okay, but it's very painful. There's not much else except to let the economy normalize by itself, and that normalization usually takes place in the labor market. It's a terrible place to be in. Okay, and it looks like this is where we are headed. Okay, so what's the other answer to this, by the way? So if we head towards a stagflation, we are in serious trouble here, because there's not much that policymakers can do. It doesn't matter if you are looking at a sort of the left or the right side. The left or the right side both have their own policy prescriptions. Neither of them are going to work in a stagflationary environment. So the one possible solution is that we have an island reversal. That's the one solution. Where's UK? Sorry, that's not what I wanted. The one solution is that this is actually an exhaustion gap, and that we actually see the supply side come back online. In other words, there's a de-escalation, and everyone goes to the tables, and diplomacy is the order of the day. Supply comes back online. We see prices moderate. That would be the island gap scenario. The island gap scenario is if we get some sort of diplomatic solution here. If it escalates, then I think it's the runaway gap that is the order of the day. So we're on a knife edge here, right? We're on a knife edge here, and we want to see how does this turn out. Now, I think that there was a gamble made by the Russians, in that they knew about the stagflationary scenario, and that the likelihood of their international oil being cut off was remote. Maybe that gamble's not paying off, because there is a possible Russian energy ban now that they're talking about. Whether that happens or not, I don't know. But if it does happen, this is a runaway gap. Okay. If it doesn't happen, and there we go to the diplomacy route, then hopefully it's an exhaustion gap. The stagflationary environment normalizes. I don't think, by the way, the Russians have a lot of time here. Just kind of the reading that I've been doing. Again, I'm no military expert at all. It just seems to me that there is such damaging sanctions here that the whole, and you guys can tell me sort of how off the mark I am and what your thoughts are, but the whole idea here is regime change in Ukraine. So, I mean, the Ukrainians are digging in to the point that it's becoming, you know, we're getting to the point where it's going to be the most deadly part of that street-to-street combat, and the defenders have the advantage here. So, I don't know. I think that it's just precarious as can be. I'm hoping this is an exhaustion gap. I'm hoping that this is an island reversal. I'm hoping that the threat of stagflation diminishes. I'm hoping we can get back to normal economics. But that's just a hope at the moment. If we go through to the DAX has gapped down. This is after a gap last week, although the gap did close somewhat, and now it's gapped down. So if we opened here, Okay, the gap seems to have disappeared on my chart. This gap clearly hasn't. So again, is this an exhaustion or a runaway gap? We're in big trouble here. This is a bear market we've been talking about as soon as we identified the lower peak, lower trough, and it's exacerbated down. But again, is this going to provide a good buying opportunity? Remember the question. Do you remember the conversation we had last week about risk premiums? How much further can risk premiums run? So again, the analogy or the analysis in terms of an island reversal. Well, is this an island reversal to the upside? I don't know. I'm just saying this is a possibility that we need to be looking out for. If I add the RSR, if we add the RSR, we deeply oversold here. Okay, we deeply oversold here. That will normalize at some stage. I don't know when. We're again in an extremely emotional, volatile environment. It can stick around here for months before it corrects. But once it corrects, the longer it sticks around in the excess, when it decides to correct, the correct is going to be huge, because it's going to be there's going to be a buildup, a mass buildup of potential energy here. Okay, that just has to explode into kinetic energy. Similarly, if we go through to US oil, okay, we're hugely overbought here. So I would imagine that there's some potential energy building up. That potential energy, what am I referring to? The potential to normalize at 124. This is high. It's too high. It's run too far, too hard, too fast. But because it's such an emotive time in the markets, well, the longer that this builds here, by the time it decides to correct, it's going to shoot down. Where did we see that before? Bitcoin. This was a 50%. This was a 50% retracement after this huge run in excess. Okay, and so we're just going to have to keep an eye on it. We'll just end off with the Bitcoin chart here, and then we'll do again more Bitcoin on Wednesday. But you can see how the Bitcoin faded. Look how it faded last week. This is a gravestone doji. Let's take a look at Ethereum. Ethereum inverted hammer. So the the cryptos don't seem to have. So I guess there was an initial thinking of benefit that seems to have subsided now. I'm also doing some sort of investigation in that. It just seems that it's going to be impossible to use the crypto markets to circumvent sanctions. It's just the crypto market's just not big enough to handle that type of liquidity. So, and besides that, most of the liquidity would be in Binance exchange or Coinbase or the regulated exchanges. So that they'll have to go through compliance. Compliance has got these algorithms that pick up activity. It's just going to be very hard for sanctioned individuals to use cryptos to bypass. And it seems that the market, and it seems that this now, as we said, I think last Wednesday, maybe penance. Maybe I think it was Howard that said that. Maybe penance. Maybe these continuation patterns. So we're just gonna now they're not continuation patterns until they're complete. So we're just gonna have to keep an eye on those. Okay. Also with commodities going up, what about AUD USD? Yeah, so that's a commodity currency. I was quite surprised that the US dollar Canadian hasn't run more than it has, Howard. But if you take a look at Aussie US dollar, there does seem to be some sort of benefit here. Okay. So a bit of a disconnect there. That's very interesting. Aussie running up against the US dollar. Let's just take a look at the US dollar. All right, I'll do a US dollar analysis. We've got a potential higher trough here. Potential because this isn't the cleanest of price action that I've seen. I would say this is our conservative measurement. If we close above this, then US dollar starts moving up. All right. Any questions, guys? Please type those in. Any questions? Please type those in. You've got my email address. Obviously, open invitation to send me any emails. It's a very uncertain environment. Uncertainty is risk. That's in the financial markets. Uncertainty is risk, and we are in a hugely uncertain environment. That is in a huge risk environment. Please take that into account in your trades. All right, guys, let's wrap up here, and I'll speak with you tomorrow. Thanks very much.